finally, we're now going to complete the cash flow statement. We are going to do the forecasting for the cash flow statement, and that is also going to help us to complete our balance sheet, which we were not able to complete because we didn't have the value for cash for the forecast of 2023, 2024 and 2025. So basically we're going to start with the net income. The net income, we obtain this directly from the income statement, which is that. We fill that right. Then we have the depreciation. We can take this directly from the income statement, and we have that. We fill that right. Then we have the account receivables, the change in account receivables. That is under cash flow from the operating activities. We have the change in networking capital. So to get the change, we are basically going to, that one was account receivables. We're going to get the difference. Actually it's that minus that. Going to get the difference to get the changes in account receivables. This one also, this is inventory. We are going to get the change here. We fill that right to get the changes. We also have the account payables. We know that when the account payable increases, that means that it did not take any money or any cash from the business. So the account payable, we are going to get that minus that to get positive. Then we also have other current liabilities, the changes in other current liabilities. Other current liabilities, we get that from the balance sheet, which is going to be this minus that. To get that, we fill that right to get those values. So now to get the net cash provided by the operating activities, simply going to get alt equal, and that is going to be 85. Then we fill that right. Okay, so we are projected the net cash from the operating activity for the next 3 years. Then we have the net addition to plant, property and equipment. This one we are going to leave it for now because we cannot obtain its values up there. So directly we are going to go to the cash flow from the financing activities. From the information we have here, there's no anywhere which we are told that this particular company is going to issue any common stock. So the common stock is going to be 0 for the next 3 years. Then the payment of dividends, that one we are given. The dividends below the income statement, we are going to have that for the next year. We fill that right. Then the net addition to long-term debt. From the information we have, we are told that in the year 2022 the debt was 13,400 and now it has increased to 20,000. So we are going to get that difference to get the net addition to long-term debt. It was not paid, but actually they added more. So those are going to be the difference. So now to get the cash flow from financing activity, just going to get alternative equal, and those are going to be the values, the cash from the financing activity. Then now we are going to get the decrease or increase in cash and equivalents. So the decrease is going to be, first of all, what we are going to do is that we are going to get the cash flow from investing activity, which is basically equal to E95. So we just fill that right. So there. So to get the increase in cash and equivalents, it's simply going to get the sum of that value from the financing activity plus from the investing activities and plus from the operating activities. So we just fill that right there. Then we'll have the cash equivalent beginning of the year. We understand that the cash equivalent at the end of 2022 was 6,806. So it means at the beginning of the year, this is the value. We get that, we fill that right, and we get that. So it means that cash and equivalent at the end of the year is going to be a sum of that. So we just fill that right, and everything will come into place. So that is the information we have so far in cash flow statement. So we are not able to complete it because we have not gotten the cash flow in the investing activity. So to get that, we have the supporting schedule, which help us earlier to get retained earnings. So first of all, what we are going to do is we are going to get the values of the net property, plant and equipment. So we were told that from the information we have up here, we are told that the capital asset turnover ratio, they are given, and this is the ratio between the net sales and the capital assets. So what we are going to do for us to get the net at the end of the period, we are simply going to get the net sales or the revenue, then we divide that by the capital asset turnover ratio. So we're just going to fill that right. Then there we go. Then the depreciation expenses, this one was already given. We can take that from the income statement, and we just fill that right, and we get that value. Then the property, plant and equipment at the beginning of the period, just as before, that one is the same as the property at the end of the period. So that is equal to that. Fill that right, and we get that value. So now to get the capital expenditure, we are simply going to get the net PPE at the end of the period, which is this. Then we subtract the one for the beginning of the period, which is in this case is E113. Then we add now the depreciation expense to get the capital expenditure. So to do that, simply now we can now go back to our investing activity, and these are the net addition to our PPEs, these values here. Then when we fill that right, we are going to be able to get that. And from now you can now see our balance sheet check is giving us okay. That means that the balance sheet balances the total assets and the total liabilities and shareholders balances. And even if you check our check, it shows you that the cash in the balance sheet and the cash in the cash flow statement is the same. So that one brings us to the completion of projecting or forecasting the three finance statements, and there you go. Thank you very much for listening.